There are two entirely different issues being handled in this presentation by Jay Powell this morning. One is the level of rates, and the other one is an entirely new policy about how they're distributing, how they're selling their treasury and asset-backed securities, and why they're doing it. So there's two things. So simply with interest rates, they leave interest rates unchanged at an effective Fed funds rate of 533 basis points. That means the lower bound is 525 and the upper bound is 5.5. But in terms of security holdings, what they announce is that in June they'll reduce the sale of treasury securities, they're selling of bonds and bills into the market, from 60 billion per month to 25 billion per month, which means they're more than cutting it in half. And the discussion later on as to why was very interesting to me. But they'll continue to sell mortgage-backed securities at 35 billion a month, and any money that they have, or any that they sell in excess of 35 billion a month, they'll put back into treasury securities. And as we learn later, that's because they're trying to stabilise what the impact that QT is already having on treasury securities and the yield. Jay Powell says that the labour market is still relatively tight, and in spite of increased supply with higher participation because of strong immigration, labour demand is still higher than labour supply. He says that core PCE inflation is still higher than they would like at 2.8%. And then he introduces an entirely new statistic that he's ever quoted before in these meetings. And he says that in spite of the fact that GDP fell between the fourth quarter of last year from an annualised rate of 3.4% to the first quarter of this year, when it was an annualised rate of 1.6%, he then says that private domestic final purchases grew at 3.1% rate in the first quarter. And it's this statistic which seems to have influenced the change in approach of the Fed. And he repeats that labour demand still exceeds supply. And at this point, he introduces the idea that the Fed now needs greater confidence in order to reduce rates, and it's likely to take longer than previously anticipated. Steve Leisman from CNBC asked him, is it a contradiction between what they're doing with assets and what they're doing with rates? Because in terms of quantitative, by still selling assets, reducing the level of quantitative tightening, he's actually easing monetary policy while keeping rates where they are. And he says, no, that's not what we're trying to do. What we're trying to do is stabilise financial markets. So this is a realisation that the volatility in the bond markets that we've seen is at least in part a result of the pace in which the Fed has been selling. And he says, rather, what we want to do is ensure a process that doesn't wind up with financial market turmoil. And then he says, the last time we did this, and the last time we did this, and the only other time we did this. And what's really interesting, nobody asked him when that was. And it was particularly interesting for me because back in 2013, I went to a detailed presentation by a guy called Randall Krosner, who was then deputy head of the Fed, about the previous time they did it. And it was way back in 1948. And the reason they did it in 1948 is that as they'd gone through World War II, they had been buying bonds to obviously finance the war. And they got to a point after the war in 1948 when they wanted to sell them, and they sold them all at once in 1 year. They cracked out the entire financing of World War II in 1 year. And the result of that was extreme market turmoil. And there was a rather savage short-term US depression. So that's the only ever time they ever did it before, and that was what he was referring to. But clearly they don't want it to get to that point, and clearly they think the enormous amount of bonds that they've been selling has been destabilising financial markets, and so they want to slow that right down. Does that mean that their policy is restrictive? Just in terms of our own market models of the Fed funds rate, our equilibrium for the Fed funds rate is 424 basis points, and it's currently 533. Yes, of course, the Fed funds rate is currently restrictive, but in response to a question about that, he said the raising of rates is extremely unlikely. Another question was from the media was, has the Fed now dropped its easing bias? He said, no, it's not that. He said that we just need more confidence. And then he said that it was path dependent and there had to be a path to rate cuts, and which he then followed up with a rather startling statement. And I quote, I don't know when that might be. From the first quarter data, it is likely to take much longer than we thought. So what seems to be the case is that the number that's changed the view of the Federal Reserve is the fact that private domestic final purchases grew at 3.1% annualised in the first quarter, far stronger than GDP. And for that reason, the Fed now needs, in Jay Powell's words, greater confidence in order to reduce rates, and that confidence is likely to take longer than previously expected.